Roger, welcome. Great to have you, especially on a day like today.
Thank you so much. Pleasure to be here.
What do you think is going on regarding the prospect of 75, the involvement of the Journal in this Nick Timiraos piece, and what that may mean about the committee's thinking?
Look, I think the prospect of 75 is very much on the table. And I think it's in large part because the incoming data, with one exception, has shown that the market continues to be very strong, overheated almost. We haven't seen what I think of people expecting, which is peak inflation. And that last CPI read, I think, really got everyone's attention. You know, I can't speak to the Journal story. It's not the norm for FOMC members to sort of work that way. So I think it's really much more about market expectations. Having said that, I will say, you know, the move from expectation of 50 basis points to the expectation of 75 basis points has been really quite dramatic. So all eyes will be on this afternoon's meeting, the discussion, and we'll figure out exactly where we go from here. But I think it's more likely than not 100% certain, more likely than not that it's going to be 75, because that's where the market expectation is now. And when they're in a tightening mode, I think they're unlikely to disappoint the market. But, you know, we'll have to wait and see.
Right. Is there value in surprising the market to the upside, being more hawkish than we think?
I don't think there's any value in that. I don't think that's really very helpful at all. I think they'll have a chance to shape expectations by meeting the market, which itself has given them permission to move a little bit more aggressively. You know, I think the market has priced in a couple of 75 basis point moves, which seem like a perfectly reasonable thing to expect given the nature of inflation. So I think the message I think that we're going to hear is one that sounds roughly as though the market has it right now, but with the expectation that since this is such a dynamic situation, you know, incoming data may force a change in hands. Change in expectations. But I see no benefit in surprising the market whatsoever. I think it's unnecessary and would be unwise.
And Roger, there's been a lot of attention on the collective projections of the committee members here. Basically, their estimates of what a neutral rate ultimately looks like at this point, and where this cycle ends, as well as, in fact, the forecast for unemployment. I mean, the Fed Jay Powell's been pretty clear that, you know, the soft landing is an ideal objective, but he's by no means guaranteeing it. And presumably you can target job openings and say maybe it's not going to cause unemployment to go up, but that's a tricky thing to contend for the long term. Do you think that the committee is going to have to say we want the economy to soften up more here to get the job done?
I think they're going to clearly signal that. I think Chairman Powell was signaling that the last time we talked about a soft-ish landing. He said, you know, there are credible paths or plausible paths, but it would be very, very difficult. You know, I've heard him, he also used the word pain, I believe. So I think we're going to hear more of that kind of language to get all of us expecting, you know, in what I think at best is going to be a bumpy ride. And I think that's very important to get the market ready, to get the population ready. But frankly, you know, their job at this stage is to get inflation under control. They've seen, and we've all seen, the cost to average households of high and rising prices, and that is really something that is causing the Fed a great deal of anguish, as it does others. So I think they are ready to go to a restrictive posture if need be, to tolerate some pain, to use their phrase, in order to get this inflationary dynamic under control, which must be done.